A couple of stocks and sectors which are under focus post what the RBI had to entail by way of gold loan norms are names like Muthoot as well as Manappuram Finance and the kind of battering that both these names have got. So let's understand the implications for the sector a little bit better. Rajiv Mehta, research analyst at India Infoline joins in. Rajiv, firstly, your outlook on names like Manappuram as well as Muthoot Finance, and after the battering that these stocks have got, is there still a case for a derating for this entire sector?
See, I think that the price correction is largely over, or maybe it can just further correct by 5% more. But maybe a time correction could set in, and everybody wants to see how what the company delivers over the next 2 quarters, when the entire book will have to be adjusting towards a 60% LTV. Because the 60% LTV rule will actually, have an impact at every levels of the business, not only on the growth, but also significantly more on the profitability. And we see a big compression because of this adjustment on the yields, on the NIMs, and also on the ROA.
Right. But would these stocks, as you're stating that the downside pressure is limited now, would these stocks be a buy, a contrarian buy for you? Or would you just stay away?
No, I think at the current point in time, the risk reward is fairly balanced. As I told you that maybe a 5-10% correction, these stocks would start trading at about 1 times book on a FY12 basis, then making it seemingly very attractive. But still then, because, it's a very uncertain time over the next 6 months, how the regulation would actually impact. Our analysis says that their ROA could actually halve. So that could be potentially be the worst case. But so everybody just wants to see, what these companies deliver on margins and on the overall profitability. But I think as far as the safety of these companies is concerned, a 60% LTV rule, really makes it more assured. If I am a creditor of the company in terms of my return of money, I am more assured because these companies would now become more assured. I'll be more not so worried about my money coming back to me. But yes, equity typically tends to overreact, and we have seen a big reaction ahead of the difficult time. But as I said, maybe there could be a time correction.
Let's chat about the financials, Rajiv, just to stretch the point that you were actually making right now. What about names like Manappuram, which has a Tier 1 ratio at about 18%? The management earlier when we spoke with them expected a PAT growth of 25% for FY13 versus 88% in FY12. Do you think capital is adequate right now? And what are your expectations of the credit growth, margins, as well as PAT growth posted by names like Manappuram as well as Muthoot? Do you think that may need now more capital? What is your estimate for the loan growth that they may post?
I think that exceptional growth phase is clearly behind these companies, and maybe as we see the adjustment happening to 60% LTV, their AUM or their asset could be stable. They will not be able to grow over the next couple of quarters, and maybe from there on a normal growth rate of 20-25% could set in. So over the next 2 years, we don't see a big growth in the asset book. So in that way, the pressure on Tier 1 capital would not be that significant, especially for Manappuram, who is having Tier 1 capital of 18%. So we don't see this capital being absorbed, at a very fast pace. I think they'll be much more comfortable because that 12% RBI's requirement is for April 2014, and I think even by that time, Manappuram will be pretty much comfortable as far as capital is concerned. And as you were asking about the NIMs, we see NIMs compressing by about 6 percentage points. So currently, Manappuram is earning 25% NIMs on the overall book. That can come down to 18-19%. And the margins, which are currently exceptionally high at about 14-15%, can correct to 9-10%. And as I said before, their ROA could virtually halve from 4.5-5% to 2.5-3%.
Right. What about aside of growth expectations, how do you think the situation would turn out in terms of the competition these finance companies are seeing from banks? Which banks do you think would benefit besides Federal and South Indian Bank if, their market share goes down?
See, from the understanding what we've been given by these companies is that the customer set, what they cater to is slightly different from banks. typically customers which comes to Manappuram, Muthoot are having a much smaller loan size of 35, 40 or 1,000, whereas those who go to the banks have got a bigger ticket size of 1 to 10 lakhs, 1 to 2 lakhs. And also given the fact that these companies are much more widespread in terms of being present in every locality, in every area, banks does not have that kind of reach. Of course, there are a few banks, in the southern India like South Indian Bank and the others who've been aggressively growing their gold loan portfolio. But at the same time, Manappuram and Muthoot have also been growing, on the sidelines. So I think it's a bigger pie. Everybody's going to grow. And in terms of competition, the 60% LTV rule will only, moderate the pressure of competition which we had over the last 1 year. It can actually, prevent new entrants, from coming into the market, given the fact that, that 4.5-5% ROAs which all the existing companies were generating would come down to 2.5-3%.
Okay, Rajiv, stay on with us. We have the management of Federal Bank also joining in to throw more perspective on this discussion. Mr. P.C. John, who's the CFO of Federal Bank, joined us on the phone line from Kochi. Mr. John, what is the impact on Federal Bank post the change in the RBI guidelines for gold loan of NBFCs essentially?
The recent guidelines of RBI on gold loan NBFCs, that is helpful for the banks in their gold loan business, because gold loan business will grow at a faster rate in banks where this restriction on LTV is not there. For NBFCs, it is capped at 60%, whereas that cap is not there for banks. That cap is not there for banks because banks have generally robust risk management systems and also proper exposure ceilings for various categories of loans.
Right, but would you be looking at now perhaps even more so actively building your gold credit portfolio?
Of course, we have been building up the gold loan portfolio at a faster rate, and that will continue. We continue to give focus on the gold loan portfolio because it is an attractive portfolio. We have proper risk management systems in place, and so that is a safe portfolio also.
So from about 10%, which you have currently, how much do you plan to scale it up by?
Presently, the gold loan portfolio is almost 10% or slightly lower than 10% of our total portfolio. So we can take it to about 15% or so. Then we can subject it to review. We will be subjecting it to review. The exposure ceilings will be constantly monitored and subjected to review.
So, Mr. John, you're saying that as of now you don't foresee any asset quality concerns on gold loans?
On gold loan, we don't foresee any asset quality concerns at all because we have been in this business for the last 6 decades. And the incidence of NPA in gold loan business is extremely low. That is perhaps one of the safest portfolios as far as Federal Bank is concerned.
Mr. John, Federal Bank is pretty high on capital adequacy. Would there be any more need for capital raising during FY13?
No, FY13 we do not require any capital raising because we are having one of the highest capital adequacies in the industry.
Right.
And that too, the quality of capital is also very good. Almost the entire capital is that of Tier 1 capital. It's a very good position. We have adequate headroom in Tier 2 also. So we do not need to raise capital in FY13 or even in FY14. FY14, of course, we have to see, but not likely.
What about your ROEs? Because they're significantly below your peers. Do you see them improving in FY13?
FY13 ROE will go up. There is steady improvement in the ROE. Next year also ROE will go up.
Rajiv, you've heard the management of Federal Bank. These are the two banks which are actively really in the business of gold loans and are building their portfolio, South Indian Bank being the other one. Is there an active buy call on these two banks?
Yes, we cover Federal Bank and we know that their gold loan book has been growing pretty fast, and it's not with them. It's also with other couple of South Indian based banks and other NBFCs. And we already have a buy call on Federal Bank with a target price of around 500. So we continue to remain buy. I think as an industry, it is highly underpenetrated, and what this regulation really seeks to do is that make it a much more safer, also from the bank's perspective when they are lending to gold loan NBFCs, and also for the retail NCD holders, it becomes much more safer investment, debt investment, the Manappuram and Muthoot NCDs at 60% LTV. So I think this regulation is fairly healthy, and it will just remove the surplus or the supernormal profits which the gold loan NBFCs were earning.
All right, Rajiv and Mr. John, we leave it at that. Thanks very much for joining us this morning and giving us your perspective on the new guidelines laid out by the RBI on gold loan